what the difference is in investing in real estate versus the stock market, and what I believe the best option for you may be. It doesn't mean that you're limited to not investing in other assets such as gold, stocks, bonds, whatever that might be, cars, collectibles. Real estate, you can leverage debt and you can rent those properties out, let the tenants pay for that rent, and then go buy more properties. This is the beautiful thing about being in the game of real estate. Do I want to make a little bit more quick money? That doesn't exist in real estate. Awesome, everyone. So welcome back to the channel once again. The only thing that I'm going to request of you is that if you find some value in this video, that you click the subscribe button, you hit the bell notification button up here, and you subscribe to the channel. Share the video and follow us, because we always every week we're putting content about where I believe is something that will provide you or a value, or anyone perhaps maybe in your family, anyone in your circle of influence that you believe may benefit from what I have to share to you, that they may benefit from that. But without further ado, all of our social media is going to be down below. Feel free to follow us, get to know us a little bit more at a personal level, because I want to get to know you. Leave us a comment, because I promise you that I will get back to you if you do that. And I also want to follow you as well. I want to see where you are, where in the country or where in the world is it that you're in, because I'm interested about you as well. I want to know what values you had to bring to us as well, so that we can share those with the community here at the channel, Through Failure and Success, which is essentially the name of our channel, Through Failure and Success, because we do this through failure by achieving success. Without further ado, the purpose of today's video is to show you a little bit about what I believe has been the key difference of investing in real estate versus the stock market. Now, there's been a lot of argument back and forth. A lot of economists, a lot of investors will tell you that maybe investing in real estate is the way to go. Maybe being in the stock market is the way to go. Some of them are saying, you know what, I diversify my portfolio in both ways. Now, what do I mean when I say portfolio? A portfolio is nothing more than where you are invested in. Now, let's just say that you don't have your money invested in anything. All you have is just your money just sitting at the bank. Well, that's where your money is. That's your portfolio. Your money is just sitting at the bank. That is it. It's really nothing as of, I'm walking around with a portfolio and showing people what I have invested in, where I'm investing. It's really nothing like that. It's just where your money is allocated. And so most economists, most investors have their portfolio diversified. Now, what do I mean by diversification? Diversification means that, let's just say 100% of my money, of everything that I have, is 100% of my money, whatever that number is. I have 50% invested in real estate. That means half of my money is invested in real estate. That is half of my portfolio. 50% of my money is invested in real estate. The other 25%, it's invested in the stock market. And the other 25%, I have it invested in gold, let's just say. There's all kinds of investments that you can do. There's gold, there's stock market, there is collectibles, there's cars, there's sports cars, there's silver. The list goes on and on and on and on and on and on. But in this case, I'm specifically going to focus on real estate and the stock market, and what both of them have done over the last 30 to 40 years. Now, here's the key difference. This is an article by Investopedia. While stock prices and house prices both reflect market value, that means that whatever the market value is at that time. Right now, the market value for a property is not the same as it was in 2009, 2010, when we saw the Great Recession. That is when the bubble burst. We saw the financial crisis burst because of the lending industry. Now, the lending industry was giving out loans essentially just to anybody that was able to prove that they were working. Doesn't matter how much income you were given. That is essentially what happened. Everybody was getting loans. If you had a dog, if you had a sister, if you had a family member, you would get a loan. But that is not the purpose of today's channel. Today's channel is to tell you that the market value back then was not the same as it is today. Now, a market value means that if the market value of a home is $600,000, The difference back then, it was must have been maybe $400,000. The difference is $200,000. That is the difference. But the market value, that is what it is of an asset. In this case, a property. One should not compare houses and stocks for market returns only. For one, stocks are historically more volatile. Now, volatile means that they have more risk. You can get more reward when you're investing in stocks, but also the rewards a lot higher. The rewards a lot higher because the risk is much higher. That is what volatile means. Then real estate. Real estate, it's more conservative. But real estate, understand that real estate, it's a long-term game. A lot of people get into the real estate industry thinking that this is a get rich quick. Today I buy real estate, tomorrow I'm gonna see all of my money back plus some. And that is not the game of real estate. Real estate does not operate at that level. Real estate, it's a long-term game. It's a game that you need to be invested, and you understand that it comes with the risk. In this market, at the recording of this video, 2020, in the 2022 actually, September 2022, real estate is booming. It has been booming for the past couple of months. Now, where is it going to be heading? Because interest rates are going up. Interest rates are historically low compared to what they were back in the 1980s. Now, when you compare that to today, when we first started the year in 2022, they have gone up twice as much. We started off the year at three, let's just say 3%. It was around 3%, 2 point something. Right now, they're 6%. And they're going to go up again at next week. And they're going to go up again at the end of the month. And I know that because Federal Reserve has already made it clear that they're going to be raising the interest rates in order to slow the demand, slow inflation. So therefore, they can slow the demand. So that's going to allow borrowers to have more options. But some of the borrowers that have options, they're going to be losing about 300 to 500, maybe 600,000, maybe $600 in purchasing power. Now, this is the perfect market for investors to get into the game. But now, stocks are more volatile than real estate, meaning that those high returns may also come with higher risk, which is what I was explaining. Stock market, and ownership interest rates is a publicly traded company. When you invest in the stock market, it is a publicly traded company that is listed in the S&P 500, or that is listed in the Nasdaq, or it's also listed in the Dow Jones. Okay, those are three different indexes that I'm not going to get into, but those are the three most popular that you'll find. The most popular that you'll hear all the time is the S&P 500. That is the top 500 companies in the country that most people put their money in. They are not tangible. It's not something that you can go out and touch it. You cannot go out and touch that asset. That is just you have your money invested in the stock market, but you essentially cannot touch it. Real estate, on the other hand, it's a tangible asset. This property, I can go touch it. I can go touch the dirt. I can go touch the land. I can touch the walls. I can touch the ceiling. I can touch the floor. I can touch the doors, whatever that may be. But this is a tangible asset. This is something that I'm able to touch. That is what tangible means. So, they're not tangible assets, physical assets, and serve no utility other than store value. Stocks are just nothing but store value. It's just like gold. Gold is a tangible asset, but it's a store value, something that you just don't go out to the store and trade it. You could, but you don't do that. It's not it doesn't have store value. And a liquid security investment. Okay, real estate, it's not like stocks. Some people speculate with real estate prices, but commercial and residential real estate serve tangible functions. If you own commercial real estate, again, that is a tangible asset. You rent the property to whoever is it that you're renting those office space to. If you own residential real estate and you're renting it out, you're renting it to your tenants, but that is yours. That's your tangible asset. People live in houses and condominiums. Businesses operate out of commercial property. Physical property has value. So again, as I was saying, real estate is a tangible asset, something that you can physically touch. Now, yes, you might have more of a return with the stock market per se, but it comes with a higher risk. and you don't have physical asset of that. You don't have physical control of what that asset, that store value might do. With real estate, yes, you may not have control where the market will dictate where it's going to go. However, you do have control of that property. You can do upgrades, you can rent it out, you can sell it, you could do whatever you want because you are the owner of that property. Now, I want to talk to you a little bit about the great moderation. Not a lot of people talk about the great moderation, but I want to touch it because this is something very, very unique. So, what is the Great Moderation? The Great Moderation is the name given to the period of decreased macroeconomic volatility experienced in the United States starting in the 1980s. During this period, the standard deviation of quarterly real gross domestic product declined by half, of the standard deviation of inflation declined by two-thirds, according to the figures reported by the former U.S. Federal Reserve. The Great Moderation can be summed up into a multi-decade period of low inflation and positive economic growth. So what does that mean? The Great Moderation is nothing more than we saw low inflation, high growth, high economic growth. That is the Great Moderation, and we experienced that from 2007. We experienced that from 1980 all the way up to 2007 until obviously we saw the Great Recession that hit us in 2009. But the key takeaway to take from this is that the Great Moderation is the name given to the period of decreased macroeconomic volatility. Again, volatility is a risk experienced in the United States from the mid 1980s to the financial crisis in 2007. Understanding the Great Moderation is a follow period of times of violent swings in an economic performance on inflation in the U.S. economy. So again, the Great Moderation is where we experience high growth but low inflation. Right now, we're not at that. Right now, it's the complete opposite. We are the complete different of what it was back then. Right now, we are seeing high inflation, low economic growth. Now, technically, if you ask me, we are in a recession. Now, I don't know why the government, I don't know why the Federal Reserve has not come forward and say that this is a recession time. But when you experience 2 quarters in a row of negative GDP, negative gross domestic product, we're technically in a recession. We are in a recession. We just haven't heard it officially yet, but we will hear it most likely at the end of the year, perhaps maybe at the beginning of next year. But we are in a recession. So now let's just say that you bought a property for $200,000, and 2 years later, that property is worth $500,000. Well, that is a $300,000 in equity that you have. Banks will allow you to pull out up to 80% of your equity, meaning that if you owe $200,000, but the property is worth $500,000, you have about $300,000 in equity, but you can only pull out $200,000 additional that you can go ahead and refinance and go buy 2 more properties with those $200,000, because 2 and 2 is 4. You have to leave at least 20% of equity in those properties, in the property, for you to be able to do the refinance. Now, what do you do with those $200,000? I know people that pull out $200,000 and then they go out and spend it all like if it's their money. You don't want to be in that position. The whole goal of pulling out the money is for you to go buy more investment properties. Now, this is real estate. You can't do that with the stock market. The stock market will not allow you. If you bought a stock for $100 and now a year later is worth $200, that is an additional $200. You can go to the stock market and say, well, you know what? My stock is worth twice as much now. Can I go ahead and pull out equity out of it? That doesn't exist. You can do that with this, with real estate, with the stock market. You're not able to do so. So that is the leverage. So that is one of the reasons for me, if you ask me what is best, to invest in the stock market, to invest in real estate. For me, it's always going to be investing in real estate. Now, it doesn't mean that you're not limited to just real estate and not invest in the stock market. That is not what I'm saying. You can have that as a second vehicle. You can have gold as a third vehicle. You can have collectibles as a fourth vehicle. You can have sports cars as a fifth vehicle. Whatever that is, as long as your money is being put to work, that is completely okay. But in this specific case, I'm talking about the stock market versus real estate. Real estate, you can leverage the debt and then go buy more properties. With the stock market, you cannot buy more real estate, more stocks when the price goes up in value. If you have $50,000 of $50,000 per se, you go to the stock market, you can buy, guess how much in stocks? Just $50,000 worth of stocks. If you have $50,000 in cash and then you go to the bank, guess how much real estate you can buy? You can buy up to $250,000 worth of real estate. This is the power of leveraging the debt. This is the power of using the debt to make more money for you. Robert Kiyosaki and Grant Cardone are some of the individuals that actually use this as a way to leverage the debt and go and make more money when it comes to buying real estate. And so for me, if you ask me, what do I think it's better? Do I think it's the stock market? Do I think it's real estate? Me personally, I believe the real estate is the way to go. So with that, understand that. Let me know if you have any questions. Let me know if there's anything that I can do for you as far as assessing what I can give you as far as not making any financial decisions, because we're not a financial advising channel, but I'm just here to provide that value. And any questions that you may have, if you agree, disagree, you think the stock market is better, you think the real estate market is better, let me know. Put those on the comment below. With that being said, don't forget to subscribe to the channel. Follow us on social media and hit the subscribe button, which is right over here. And let us know what other videos you may want to hear. With that, take care, everybody. Bye bye.